Hi, so today we'll be talking about Whole Foods Market. This is Sanjeev Advani for a senior seminar with Professor Olson. Whole Foods is a grocery store chain with stores in the US, Canada, and UK. It was started in the 1980s, to be exact, September 20th, 1980. And it is headquartered in Austin, Texas. Founded by John Mackey, who is the CEO and is currently a publicly traded company. These are the 6 slides we'll go through for the company, and it will summarize different financial situations while going through and giving some advice as to what we think the company should do. So we now have the balance sheet for Whole Foods, which shows the total assets growing from $4.29 billion to $5.54 billion since 2011, which equates out to about a 30% increase in those 3 years there. And that actually shows a pretty good return on your investment should you be an investor solely on those numbers alone. When going into the common size balance sheet, we can see that Whole Foods runs about a 30% debt on the company, which doesn't prove to be all that high. It's pretty serviceable, and they have funds to back up their debt as well, so they're not completely funded in debt. They have enough cash to provide their daily needs and their shareholders with the earnings that they would expect. So next, looking at the trend series for the balance sheet for Whole Foods, we can see that year over year their dividends payable are increasing by approximately 50%. That is a pretty hefty sum to be increasing dividends. However, they're not trying to increase in massive proportion and are currently showing good inventory and property as well. Alright, looking at the income statement, what we're able to see here is that gross profit is actually going up 14% year over year. And basically what that's saying is each year they're increasing their profit by about 14% over the previous year. What we like to see is about that number, really, and if we can, just kind of keep the stock floating along right at that ROI as well. So what we're trying to show here is Whole Foods versus its competitor Sprouts. Sprouts pays about 5% extra in cost of revenue, which we're hypothesizing shows up on the net income line, seeing as Whole Foods pays about 5% less than Sprouts in cost of revenue, and also shows about 4% higher profit margin overall. So in this slide, we're trying to show how Whole Foods has a 15% more perishable items in their stores. This could also relate to a higher profit margin for them as well, seeing as perishable items tend to have a higher profit margin on them. So since their stores have a higher percentage of perishable items, they're going to have a higher profit margin overall. So looking at Whole Foods board, we can see that a majority of them are male, approximately 75%, and a majority of them are in their 50s and 60s as well, which we kind of expected. The upsides to this are there are a lot of companies being represented by their board of directors, which shows a lot of experience in different fields, not just in business, and so that can be very helpful to them as well. In our memorandum, basically we're just going over the previous facts of how the company's grown 14% year over year, paying a 50% increased dividend year over year as well. And in our recommendations, we're trying to say that maybe they should be looking at paying a little bit less of a dividend so they can use the cash to increase their growth a little bit more, and bring on some more female members of the board. Seeing as everyone's educated, that should be good there. Whole Foods has kind of gotten an interesting reputation within the past couple of years, and fiscally, the company, as we can see, is growing very well and has a great reputation attached to it. And I see that to continue growing as they attract, more top level executives and finely tune their processes as well.